Thank you, team. Thank you, Steve, Stell,
Thank you,
and
Dale.
Blake.
And Blake.
And welcome back to
Thanks,
F.A.C.E,
Dale.
Chris, Capre. Been a long time.
Good to see you. How you doing?
Yeah, I don't see you, but I hear you. And
Hold on one second here.
yeah, how have you
There
been?
we go.
Oh, okay. All right. You're gonna embarrass me now. So I have to use my video then too. So what have you been doing, buddy? I mean, gosh, what a year, right? What a few years.
I mean, I was actually just talking about this with my girlfriend that, I think 2020 was an interesting year because we had this huge influx of traders into the market that obviously changed the markets drastically.
Yeah.
But then 2021 seemed to have like a very different flavor. It started off the same as 2020, just gangbusters. But then, the theme that stocks always go up didn't quite play itself out for a few months after that. And then we kind of had this pullback in the last few months. And really what we're seeing, and I want to show you my screen, that I think this is really what I've been keeping an eye on, which is options. I've actually moved heavy into options trading. And
Interesting. Okay.
that is because of the fact that what we're seeing now in the options market is something we've never seen before. So this is September data. You can see now that SPX notional volume is now way past futures, which is kind of interesting and important to understand, because if you're not aware of how options are affecting the market and it's bigger than futures right now, then you're missing something that's having a major impact on the market.
Yeah, it's getting market makers. It's squeezing market makers in the stock, right?
It's partially that, but it's also what we're seeing is, single stock option volume has exploded. Again, this is September data. I'm going to show you the quad witching data, which just happened on Friday. And so you're seeing that single stock option volume has absolutely exploded. And it's actually now ahead of shares. So that means that right now, people are trading more options by a lot, 140% more options than they are in the underlying shares. And that's obviously going to have an impact not just upon liquidity, but hedging requirements, how dealers and market makers are trading those stocks. And it also amplifies the effects of options. If people are wondering, how could Tesla gain 50% in 4 weeks? How could AMD gain 50% in 4 weeks? How could NVIDIA gain 50% in like 5-6 weeks? It wasn't due to underlying shares. It was actually due to the options market exploding.
It's gamma, right, buddy? Your fraternity. You were in gamma red. Right.
It was definitely partially gamma for sure. There's a lot of dealer and market makers having to buy. That's what a gamma squeeze is. The option market is reflexive. So if I buy 100 SPY calls, dealers are short 100 SPY calls.
Right.
That means they have upside exposure. So then they have to actually buy futures or buy SPY ETFs to offset that. And the gamma squeeze, when you're long options, works for you, and that creates convexivity. And so as that increases, dealers have to buy more of those stocks. And so you create the gamma
amplifies
squeeze.
The move.
Yes. And so what we're seeing now, take a look at this beast now. This was the quad witching. And look at this here.
Yeah.
Early SPX account for more than half of the 4.3 trillion options that had just expired. So a couple of your guests were saying, they don't expect volatility this week. I'm actually going to take the opposite side of that. I'm expecting this week to be volatile, at least for the first few sessions. And that's because when you have that many options coming off the board, like SPX had about 30% of the total options coming off the board.
Yeah.
And you're talking a lot of single names like the Teslas, like the NVIDIAs, like the AMDs.
They expired Friday too?
They expired Friday. SPX is in the morning and then SPY is in the afternoon.
Okay.
And so a lot of those single name stocks had about 50% of their gamma coming off the board. So anytime you take that amount of positioning off the board, you're going to get volatility. And so with that being said, let me show you what happened on the last November OPEX in SPYs. And this is a very, very straightforward chart, and it becomes very easy to see. So this is positive gamma environment. Positive gamma is when the market is net long options. That is constructive. Dealers buy dips and then they'll sell rips, and they will provide liquidity to the market, basically. So it creates this stability, which is what you're seeing right here. This increase in volatility, this was right here. This is the 19th. That's the OPEX. Look what happens to the volatility after the OPEX. We see the volatility expand massively. You pull that many options off the board, volatility increases. That doesn't mean that the direction is down or up. It just means that volatility is going to increase. And we just had to
go from an orderly market to a disorderly market.
Yes. Yes, much more. And negative gamma is, from an options perspective, is when the market is net short options. So instead of dealers providing liquidity, they're taking liquidity away. Instead of providing stability, they're destabilizing the market. What that basically means is that they're trading with the market now. So if the market goes down, they're selling that. If the market goes up, they're buying that. And that increases the volatility. That's why you saw this massive change in swings compared to the positive gamma environment.
Right.
This right here was simply a Vanna induced rally. VIX at this point was now like 30, 31, 32, 33.
Yeah. Yeah.
We all know when IV gets too high, eventually it gets too rich. Eventually gets to a point where it's so high that you don't have enough, or there's not enough capital to keep buying those puts because the puts are expensive, or buying VIX because the VIX is expensive. So if it doesn't have enough capital to commit at those higher prices, then it starts to come down. IV comes down, you get a Vanna rally off that. And that's what we saw over the last 2 days. After that, that Vanna fuel is gone. The reason why the market didn't continue after that is simply because of the fact that the Vanna was the rally, but nobody was committing calls to at the money or higher the money prices. And so because of that, it didn't pull the market higher. And then what happened is traders started to buy short dated protection leading into the FOMC, which is this day.
Right.
And so that short dated put protection, because it was positive gamma, if you notice, it wasn't as volatile this. So it was down, but it was much more stable and contained in contrast to this. So this is kind of what's been happening over the last few days. Now, all of those 30% SPX options off the board. A lot of those single names, 50% off the board. That creates a kind of a vacuum, so to say, and that the options base has to rebuild. And so I'm expecting volatility.
Does that take a lot of time?
It depends. It depends. So if you start to see high volumes come in on a Monday, then it tends to support prices, especially if they're committing to calls. The problem we got right now is VIX is elevated right off the bat. And so that creates a Vanna trade to the downside, or it actually increases this destabilizing effect. And is that as IV increases, put volatility increases massively. IV charges puts way more than it does calls. And so because of that, the market is kind of in this put dominated environment right now.
Yeah.
And we're not seeing a lot of gamma build up right now. And so we need to see how the market opens. If we start to see traders fill in calls, on SPYs right around 460, then it should pull the market up to 460. But right now, the SPX is in a vulnerable position to where, let me go to a 1 hour chart to show this.
Actually, and doesn't the holiday period actually exacerbate what could happen here, Chris? Everyone thinks that, the year's over and they went to Bermuda.
Yes.
Go ahead.
Without a doubt, lower liquidity conditions are going to exacerbate it. And if anything, that will increase the volatility of volatility. So volatility is really just a measure of how much an underlying asset can move up or down, within a certain time period. The volatility of volatility is how frequent that expression of volatility happens. And during low liquidity environments, you tend to see an increase in the volatility, which is VXX basically. So I think traders need to be watching VIX very closely today. With VIX elevated at 25, 26, that could lead to, if calls don't rush in right off the bat, then traders are going to start buying put protection. And in a put dominated environment, and the markets are in negative gamma right now, SPX is starting in negative gamma. Qs and IWMs are already in negative gamma, and now they're in even further. And so with all the markets starting into negative gamma environment, that should increase volatility in the major indices.
Okay. Any comment on, say, for example, there is some, we maybe finish off this break today into the solstice. I know it has nothing to do with option buying. And the fact that we took out the lows from a month ago or 3 weeks ago, and the VIX is not at 32. Is that a message to you at all?
I think I wouldn't look at it quite like that, but I generally, statistically, VIX 30 and above has generally correlated to positive returns for the S&P, the SPYs over the next 20 days. And again, that really just comes down to the fact that it's pretty rich at that point. If you look at VIX historically, once you get to 30, other than the COVID rallies here, if it gets above 30, it's being sold after that. It's being sold after that consistently. And so, if you buy a car and you're happy to buy a car at $100,000, you may not be that excited to buy it at $150,000. And that's what VIX is when you start getting above 30. It starts getting rich. And the richer it gets, the more capital it needs to keep it elevated. And if it's just not there, then it's going to come back down. You see IB get crushed and it creates a Vanna-induced rally. So Vanna
Revert to
is
the mean.
Yes, Vanna is simply the changing a delta as implied volatility changes. And that has more of an effect in a put dominated environment than it does in a call dominated environment. And sadly, right now we're in that put environment.
You've gone Greek on me, Chris. I mean, really,
Well, I've always been an order flow trader. Like, to me, everything was about order flow. Order flow is, going to be the most proximate driver price action, whether it's the fundamental reasons of people buying and selling a stock or currency, whether it's the sentiment, whether it's the technical or flow based. They all have one common denominator. It's order flow. And the thing about it is, in the FX market, order flow is opaque. It's not transparent. Stocks, it's more transparent. But in the options market, it's not just transparent, it's reflexive. I know that if I buy, 100 Tesla calls, I know what the dealer is doing. And I also know what the dealers to offset that as well. So I'm long 100 calls. I know they're short 100 calls. That's reflexive. And then I know they're going to buy shares based upon the delta position that I take. So that's reflexive. And reflexivity creates predictability. It creates reactivity. And so once I really started to dive into market gamma, which is really, dealer gamma option positioning, dealers hedge right off the bat. That's delta hedging. But then they gamma hedge as the position changes. And they're also going to hedge based upon implied volatility. And that's all reflexive. And so because of that reflexivity, I decided to head into it because of the fact that the reflexivity creates predictability and allows us to, as traders, say, hey, the next, session should be volatile, not volatile. That changes strategies massively.
One of the first times I heard that term, reflexive market, and that's why some people changed, it was their move to crypto, because they believed that crypto was very reflexive. So what's a similarity as far as reflexivity between the options market and crypto?
From what I've seen, actually, crypto is actually starting to get options. I've heard that there are a few brokers out there that are offering options. I don't know about the regulations around that, or I don't know who's doing it, or, liquidity and things like that. But if the same structure and backbone of the options market that is in the stocks and equities and indices moves into crypto, then you're going to get much more reflexive activity in crypto as well. And I think that would be a healthy thing, because then that would wrestle some of the control away from the whales who tend to dominate a lot of the price action in crypto. And that does help democratize the market. It makes it much more even, because then they can't control the reflexivity the same. They still can, they can influence it, but then they have to move into options. They can't just be trading spot to do that.
Okay, interesting, Chris. So, for some people, options are like relationships. 90% of them expire worthless. So I'm wondering if you're just buying, or you're executing different types of strategies, verticals or risk reversals, and also the cost of option trading. You could trade equities for free. Most places you can't trade options for free, and those costs they could run up. I mean, $1.60 a pop if you're doing 100 lots. So just wondering what kind of option strategies that you're executing, and where you found to keep costs down. I know you.
Yeah, this is a great question. So let me give a brief kind of taste of some of the options trading I'm doing. So I day trade options, I swing trade options, and I do some leaps. I usually pick 5 or 10 instruments that I want to do some leaps on 1 year out, basically. So I buy them in December or January, and then I set them to expire the next January, because I believe certain stocks will capture large movements. But let's take an example of, this most recent situation here. We had this Vanna-induced rally, and then we did not see a new commitment of calls to the market. The Vanna was exhausted out of the market, and kind of like a spaceship, if it uses a lot of fuel to get in orbit and doesn't have any more after that, then it can circle in orbit, but it doesn't really have anything to rally onto the moon or Mars or anything like that. And so what happened was, with this little trade right here, I knew that implied volatility is going to come down. So I'm going to trade that crush in implied volatility. So I sold straddles the first day, 0 days to expiration. So this the white is the market. This is pre-market. I literally sold straddles right on the open. As long as it closed inside their range, I kept the full premium, and that's it. The next day we sold iron butterflies, which is a neutral strategy that it's basically the same strategy in the sense of you want the market to stay within a range. If it closes inside that range, I keep a varying level of premium on that.
Okay.
Once this puts start to get into the market, then you say, okay, it's short dated, which means that I have to trade with that. I have to, be in and out.
1 week options,
or even 0 days to expiration. With the
Okay.
SPYs, you get 3 times a week that you can do that. So Monday, Wednesday, Fridays, you can do 0 days to expiration. But then, leading into the FOMC, we brought broker-wing butterflies to the upside. We felt like instead of buying straight call spreads, which is good, that you're going to capture some of the upside, but you're not going to capture as much volatility. And so we decided to buy broker-wing butterflies because we felt like volatility was low going into this and that it would increase. And so we captured some of that. This week,
I have a question about that day, Chris, because, I covered a lot of my shorts, feeling like a genius, right before the Fed. And, we had that huge rally after the Fed. Was there anything up there that told you that we were going to give up all those gains in one day?
The OPRA data. So OPRA, OPRA.com that's the organization that collects, collates, and publishes all the data. You have to subscribe to it. It's not cheap. It's expensive. And then you need a program to collate all that data. They will update the data at midnight. And so in the morning, when I get up in the morning, I can see that updated data. And here's the interesting thing about what the OPRA data was saying. It was saying this rally on that day, all short dated options. Nobody was committing to longer dated options.
Interesting.
On top of it, the other part of it was that the overall put notional interest did not change much. We did not see much changes in open interest on anything expiring on the 17th or the following week out. And so when you see that there's nobody committing to new calls, especially at new calls at higher strikes, that's telling you that traders are not bullish on it. If they were, they would commit to calls at the money or out of the money strikes. We didn't see that. And so because
what great
of that,
market tells you get so many messages there, that you don't see if you're not following this kind of information, because there was nothing you could get from the chart really that told you, that rally wasn't going to have good follow through.
No.
Nothing
and that's
technically.
And that's part of the reason why I decided to dive into it, because without this data, traders tend to become a little more reactive. And I can be reactive, but it requires you to be really quick. It requires you to adjust really fast. And the problem is it doesn't allow me to set up positions ahead of time, having a good idea of what's the most likely direction going forward. But with this order flow data being reflexive, it gives me the opportunity to say, okay, I can at least know based upon this whether the market's going to be more volatile or less volatile. That matters. I can know whether, hey, are we in a positive gamma environment, which is supportive? Or are we in a negative gamma environment? That changes strategies. Positive gamma environment, you don't want to be long volatility because it's much more mean reversion with a general bullish bias. So if you're long volatility, you're just going to lose on the IV on that. So I can take more mean reversion strategies on that. I can buy dips in the S&P 500, when it starts to go into those support levels where there's a lot of gamma there. And so it allows me to be more responsive instead of reactive. And I gotta admit, if I didn't have that data, I would have been still long, and then I would have been stopped out.
Okay. So you have an edge that you didn't have before, moving into new instruments, and congratulations on adjusting. And, you have a nose for finding the edge, Chris. I've been talking
as
to
do
you for
you
years.
As do you. I've seen your trades. I follow your Twitter feed. I look at your call outs and your experience. I think that's something that people undervalue is experience. Experience matters. I've seen a lot. I've been this 21 years. So I've seen 3 market crashes, but you've seen more. And experience matters. Dave Portnoy, he became famous recently and saying stocks always go up, and Warren Buffett's never been in a pandemic. And I'm like, that's true, but Warren Buffett has decades of experience. You don't. And experience matters because you've seen everything under the sun. You've seen every pattern, and you can't put a price on that. The chart patterns and chart times that you've seen is immense. You're probably talking 60, 70,000 hours behind the charts. And you've seen various changes in structures, in environments and macro and everything like that. And so, your students are very lucky that they benefit from your experience, because to get that these days is hard. Most of the YouTubers are like, been trading for 6-7 years and they're calling themselves experts. And it's like, no. If you weren't even around the Greenspan days, I'm going to question your expertness in the markets.
They don't even know they don't know the briefcase indicator. So
the briefcase was like, I was talking about this on Twitter the other day, and I'm like,
really?
There was these new YouTubers that are like, what does the briefcase have to do with it? And I'm like, yeah, you don't know what you're talking about. Like, literally the size of his briefcase had a huge effect on volatility.
When the rate cycle changes and everyone thinks it's the Fed, they're going to learn about bond vigilantes eventually too, right?
Exactly. So, well, and remember NFP, NFP in the early days used to have a huge impact upon the market. Like we used to see Euro dollar Swiss move 110 pips, within the first few ticks. Now you're lucky if you can get that in a day. Yeah. So the markets have changed, but the experience and your ability to go through all these environments, your students are very lucky to have you, because I've seen your calls and you are consistently using that experience to say, hey, this is what I see going on next in the market. And a lot of your calls are on point.
Thank you so much, Chris. I appreciate the compliments. So are you teaching people how to do this now, or you have a business model for your shift?
So I'm actually teaching an option course, and I'll put this in the chat here. I'm teaching an option course with Benzinga. So I partner with Benzinga, and I don't know if you know what Benzinga is, but they are a newswire service. Yeah, they have an app which kind of publishes news and alerts in real time and allows you to analyze earnings data and things like that. And so they have created an option school, and I partner with them to help teach these same principles and strategies and how traders can move up the skill levels and options. Because you probably had this similar experience. Options is not easy. My brain was like totally confused for months. Yeah. And it's not the same as like buying a currency. Like you trade currencies, it's very straightforward. You want it to go up, you want it to go down, maybe get a little carry. That's it. With options,
you decide it's kind of if you're going to be the house or not.
Yeah. Right? Well, it's not just whether you get a chance to sell options, so you collect the premium, kind of like you get to be the car insurance guy that sells the insurance policy. But then the other part of it is that if you think about it, you can't, you don't make money via time or volatility per se. Just the expression of volatility doesn't increase or decrease your profits unless you get it directionally right. But in options, you can make money directionally, non-directionally, time, volatility, moneyness, all these things and there's convexivity to it. If I'm long your dollar, for every 100 pips it goes up, I make the same amount of money. But in stocks, if you're long calls, you're long gamma, there's convexivity to it. Those profits accelerate as it goes in your direction. And so it's like going from checkers to chess. It's a more complicated game. There's way more ways to move the pieces on the board. But once you learn it, you start to say, wow, there's a lot of opportunities here. And the reflexivity was really the final piece of the puzzle for me.
Well, congratulations on the course. I'd like to sit in. I know I could learn from you, and I'm getting one question, Chris, and you talked about you buy 1 year options. So have you expressed any views for next year, any views on SPX for next year based on current options positioning after the current vol phase has subsided?
Not on SPX. I've taken some leaps on Apple. It's hard not to be bullish on Apple for the next year. Ford, I've taken some leaps on Ford. I'm trying to think if there's any other stocks I have leaps on. Not right now, but with the SPX trader, we need to see how it closes the month, because if the VIX keeps ripping on the day and SPX starts pushing, like SPX is going to open below 4,600. And that puts the market in this environment now where we could start testing 4,500 pretty quickly.
Right.
Negative gamma, again, increases volatility. If we lose 45.85, then we could see a rip down to 4,500 really quick. And it could be, 1 to 2 sessions. Could be today.
or
If
tomorrow's
we
open?
start to see that, then I would be much more cautious on forward-looking SPX options. However, if VIX starts to, kind of deflate early on and traders start buying calls, they're not buying that put protection, and SPX closes above 4,600 and starts to create this kind of Santa Claus rally, which is much more common than a sell-off, then I think it bodes very well. But I do think gains will be much more muted next year than they are this year. When you have options volume as high as they are, how much more can that get before it starts to run out of fuel? It's an enormous amount right now. So I would, I think we need to let this month settle. Once we get an idea of how this week and this month settles, then I think we'll have a really good idea for forward-looking, options on the SPX. But right now, I'm not ready to make the call on the SPX.
Yeah, do the right thing today, and tomorrow takes care of itself.
Yes.
And
keep an eye on VIX. Keep an eye on VIX. Keep an eye on SPYs. And whatever you see VIX doing, if VIX keeps ripping, you should be cautious on long exposure on the SPX today. If VIX starts coming down, that will create a Van-induced rally. That should be much more supportive. And the key will be, will traders, are they building up calls at the money or above the money? Because that means they're saying, hey, in the future, we're bullish. We think it's going to go higher.
Chris Capre, happy holidays, Merry Christmas, Happy New Year to you, my trading warrior brother. Great
and to
see
you, amigo.
Yes. The check's on the way for the endorsement you gave me during the interview. And really, it's great to talk to you. And let's not let as much time between interviews and having a chance to talk. A lot of eye-opening stuff today, Chris. I thank you, and the community thanks you. And you could find Chris. He has the link there if you want to take a course. What they say, sometimes you go in and you audit a course. So maybe I'll audit your course. And
that would be awesome. I always love working with you in any capacity.
All right,
and it's always good to see you. You're having such a positive impact. So keep doing what you're doing. Stay healthy.
All right, buddy. Chris Capre, everybody. And you could also find him at Second Skies FX. Is that it, right? That's it, right, Chris? At Second Skies?
That's it. SecondSkiesForex.com.
All right. All right. So Happy New Year, Chris. Kill them next year.
You too. Be well and stay healthy, amigo.
All right. Okay. That's a wrap, everyone. Good hunting. Remember, don't just count your pips, count your blessings. And you could join the team in 13 minutes on Morning Edge. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.